Welcome to StokTok's deep dive into United Parcel Service. United Parcel Service is one of the world's largest package delivery and supply chain management companies, moving millions of parcels and freight shipments daily across more than 200 countries and territories. At the time of recording, the stock is trading at 106.44, sitting comfortably between its 52-week low of 82 and its 52-week high of 122.41. The 50-day moving average stands at 105.56, and the 200-day moving average sits at 95.14, meaning the price is above both trend lines, a constructive structural setup. The RSI, or Relative Strength Index, a momentum indicator scaled from 0 to 100, reads 66.1, which we would characterize as neutral to modestly firm, not yet in overbought territory. Let's work through the fundamentals, scene by scene, starting with a quick business overview. United Parcel Service generates the vast majority of its revenue from domestic and international package delivery, underpinned by an unmatched ground and air logistics network built over more than a century. That physical infrastructure, hubs, aircraft, delivery vehicles, and a deeply embedded customer base represents a formidable barrier to entry. The StokTok score for United Parcel Service comes in at 34 out of 100, which places it in the avoid tier. Breaking that down across 5 dimensions: valuation scores 10 out of 20, financial health 9 out of 20, profitability 7 out of 20, growth 0 out of 20, and smart money 8 out of 20. The composite picture, as we will see, is dominated by a growth challenge that is difficult to overlook. Now, valuation. The question every investor has to answer: are you paying the right price? On a trailing price-to-earnings basis, that is, the current share price divided by the last 12 months of earnings per share, United Parcel Service trades at 16.23 times. That is not an egregious multiple for a large-cap industrial, and the forward price-to-earnings ratio, based on next 12 months consensus estimates, compresses slightly to 15.16 times, suggesting the street expects some degree of earnings recovery. However, the PEG ratio, which divides the price-to-earnings multiple by the expected earnings growth rate, where a reading below 1 is typically considered attractive, stands at 2.16. That is a meaningful premium and warrants caution, in our opinion, because it implies the market may be pricing in growth that the business has not yet demonstrated. The EV to EBITDA multiple, which measures enterprise value against earnings before interest, taxes, depreciation, and amortization, and is widely used to compare capital structure-neutral valuations, sits at 9.49 times, broadly in line with industrial sector peers. The GuruFocus Value, an intrinsic value estimate derived from historical multiples and future projections, stands at 133.93 at the time of recording, implying a margin of safety, the discount from intrinsic value, of approximately 20.53%. That discount is notable and, in our view, partially explains why 28 Wall Street analysts maintain a consensus mean price target of 113 at the time of recording, with the high end of that range reaching 135. On the competitive moat, United Parcel Service benefits from powerful network effects and significant cost advantages rooted in its integrated logistics infrastructure, assets that take decades and tens of billions of dollars to replicate. In our view, regarding the earnings calendar, the next report is due April 28 of 2026, with the street expecting earnings per share of approximately 1.06, with estimates ranging from 0.98 to 1.25, a wide dispersion that itself signals uncertainty. Market sentiment around United Parcel Service, as of the creation of this video, leans neutral, with insufficient recent news flow to shift the needle in either direction. On balance, the valuation setup looks modestly interesting to us, but the PEG and the growth backdrop complicate the case. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist that grades a company across profitability, leverage, and operating efficiency signals, comes in at 6 out of 9 for United Parcel Service. A score of 6 is solidly in the mid-tier range, not a distressed balance sheet, but not a pristine one either. More attention-grabbing is the Altman Z score, a widely used model that predicts financial distress risk by combining 5 accounting ratios into a single number. United Parcel Service scores 2.98, which places it in the gray zone, above the distress threshold of 1.81, but below the safe zone threshold of 2.99. In plain terms, the model is not flashing red, but it is flagging elevated leverage risk. That concern is reinforced by the cash-to-debt ratio of 0.21, meaning the company holds only about 21 cents of cash for every dollar of debt on the balance sheet. A thin liquidity cushion. The interest coverage ratio, which measures how many times over operating income can service interest expense, stands at 7.74 times, adequate, but not fortress level. The current ratio, a measure of short-term assets relative to short-term liabilities, is 1.22, which is acceptable. Debt to equity of 1.76 reflects a levered capital structure, meaning United Parcel Service has significantly more debt than equity financing its operations. The verdict here, in our view, the balance sheet is functional but not a source of competitive strength, and the leverage profile deserves ongoing monitoring. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital, a measure of how effectively management deploys every dollar of invested capital to generate returns, which stands at 10.60% for United Parcel Service. That is a respectable figure and sits comfortably above most estimates of the company's cost of capital, meaning the business is, at a minimum, creating value rather than destroying it. However, by the standards of capital-light technology or software peers, it is not exceptional. The gross margin revenue minus the direct costs of delivering those packages, expressed as a proportion of revenue, is 18.08%. For a physical logistics operator with enormous fixed infrastructure costs, that is the expected ballpark, though it leaves limited room for error as input costs fluctuate. The operating margin, which strips out overhead and administrative expenses, is 8.87% again, respectable for the sector. The net margin, the bottom line percentage of every revenue dollar that becomes profit after all expenses including interest and taxes, is 6.29%. The free cash flow margin, the proportion of revenue that converts into actual discretionary cash after capital expenditures, comes in at 5.37%. That figure is critical because it is the free cash flow, not accounting earnings, that ultimately funds dividends and debt reduction. In our view, United Parcel Service is a modestly profitable business by industrial standards, but the margin structure does not provide significant buffer if volumes or pricing come under sustained pressure. Onto growth. Is this business expanding and at what rate? This is where the StokTok score for United Parcel Service takes its most significant hit, a 0 out of 20 on growth, and the data makes clear why. Over the trailing 3 years, revenue has contracted at a rate of -4%. Let that sink in. The top line has been shrinking, not growing over that window. Extend the horizon to the trailing 5 years, and the picture improves only marginally, revenue growth of just 0.4% in aggregate over that period. That is effectively flat for 5 years. Book value per share growth over the trailing 3 years is -6%, meaning shareholder equity on a per-share basis has been eroding, partly a function of the elevated leverage and share buyback activity. Now, the one meaningful offset here is the dividend yield of 6.16% at the time of recording. That is a substantial income stream, and for investors who are willing to accept muted capital appreciation in exchange for current yield, it is not insignificant. However, a dividend yield this high on a business with declining revenues can sometimes be a signal that the market is discounting future dividend sustainability risk, a factor we would want to monitor closely. The bear case for United Parcel Service, in our view, rests heavily on this growth picture. A business that is not expanding its top line, is carrying meaningful leverage, and is paying out a substantial dividend that depends on a free cash flow base that has not been growing. The growth dimension is, candidly, the most challenging aspect of this investment case. Now let's talk smart money. What institutional capital is actually doing with this name? 18 top-tier institutional investors and super investors tracked by Dataroma currently hold United Parcel Service in their portfolios. That is a non-trivial number and suggests the stock is not being ignored by serious long-term capital allocators. Among the most notable holders, Bill Miller of Miller Value Partners carries a position representing 3.03% of his portfolio with no change in the most recent filing, a conviction hold from a manager known for deep value contrarian positions. The Hillman Value Fund holds United Parcel Service at 2.75% of portfolio, but has reduced the position by 16.79%, which is a meaningful trim. Robert Alstein of Alstein Capital Management holds a 1.30% position and has also been reducing, down 12.33%. On the other side, Tweedy Brown, one of the most respected value-oriented institutions in the business, has been adding up 15.16%, albeit from a small 0.08% portfolio weight. Lee Ainsley of Maverick Capital, meanwhile, has aggressively reduced the position by 83.93%, effectively exiting, which is a signal the market should not dismiss. Stepping back to the broader institutional picture, only 11.8% of 13F filers, that is, institutions required to disclose equity holdings, are classified as net buyers. When more than 50% of filers are buying, we would consider that a bullish signal. 11.8% is well below that threshold and suggests that institutional sentiment is broadly cautious. Insider ownership stands at just 0.33%, meaning management has minimal personal financial alignment with outside shareholders. In the trailing 3 months, there have been 0 insider purchases and 1 insider sale. In our view, the smart money picture here is mixed at best. Some deep value names are holding or adding in small size, but the broader institutional flow and insider activity do not reflect strong conviction in near-term upside. And finally, the verdict. Let's bring it all together. On valuation, the trailing and forward multiples are not stretched by industrial standards, and the GuruFocus Value estimate implies a meaningful discount at the time of recording, but the PEG ratio of 2.16 tempers that case. In our view, the valuation is modestly interesting but not compelling on its own. On financial strength, the Altman Z score gray zone reading, a cash-to-debt ratio of 0.21, and a debt-to-equity of 1.76 suggest a balance sheet that is functional but carrying real leverage risk that limits strategic flexibility. On profitability, and return on invested capital above 10% and positive free cash flow are genuine positives, but the margin structure leaves little room for operational surprises. On growth, this is the critical issue. 3 years of negative revenue growth and negative book value growth, combined with near-zero 5-year top-line expansion, make it very difficult to build an optimistic forward earnings case without assuming a significant operational turnaround. On smart money, institutional flows are broadly cautious, insider ownership is minimal, and recent insider activity includes a sale with no offsetting purchases, not a constructive signal. The overall thesis, based on what we see, is that United Parcel Service is a structurally important franchise trading at a discount to intrinsic value estimates, but the burden of proof lies firmly with management to demonstrate revenue stabilization and margin recovery before the growth dimension improves. The StokTok score of 34 out of 100 reflects that challenge. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on United Parcel Service. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.